Hello, guys. So, here we are for our first online class. Chapter 9, the master budget. So, first of all, this is a condensed class, so please take a look at our textbook and so on. We are not working with our Excel file now. I will be working only with our PowerPoint. However, on Moodle, on the third exam folder, there are two Excel files. The master budget Moodle, that is the one with empty cells. You can practice on that and so on, and a second one called the master budget. That is the complete file with all the formulas and so on. Okay, so let's start it. Four topics. So I will be talking about the whole chapter 9. I know that the first class we had in class, but let's go through all of our topics. It will be easier. Okay, so four topics. And how and why managers use budgets. Basically, it's for planning. So we start planning with our budget, planning our revenues, expenses, and then we act our daily basis stuffs, and then we compare budget with the actual numbers. This is our next chapter, our chapter 10. And then develop strategy, and then we go back to planning again. So budget, very, very important for planning. However, planning, we can talk about long-term and short-term planning. Long-term planning, basically it will be our last exam. Our final exam, we will be talking about long-term. We will start on that on chapter 12, that is third exam, but we will be talking more about that in the future. That is our strategic planning. Usually, we plan it for the next 5 to 10 years into the future. And then short term planning, we are talking about budget, usually for the next 12 months. And then the master budget, comprehensive planning to entire organization, and it consists on operating budgets and financial budgets. So this is our chapter 9. This is our class today. Sales, we start with sales budget. We need to know how much money will we have to spend it. And then we go through production budget, direct materials, labor, and overhead. And then operating expenses and budget income statement. These are the operating budget. Financial budget, capital expenditure budget, if we are purchasing equipment and so on, cash budgets, and then we add it with our balance sheet. So how do we do that? First of all, sales. And then sales, basically we need the number of units sales times sales price. So for instance, here our Tucson Tortilla Company, unit sales January, February, and March, sales price, and here our cash sales and credit sales. And by the way, I will be doing a special video for our master budget project. That is what you need to show me on the uh, third presentation. Okay. And then production budget, unit need for sale plus desired ending inventory equal total units needed less beginning inventory is our units to produce. So, okay, I intend to sell 20,000 units, and then I desire 5,000 units as ending inventory. So I need 25,000 units, 20 for sales, 5 for ending inventory. However, I have 10,000 units in my inventory, my beginning inventory. So I need to produce only 15. And here, uh, And then how do we know our ending inventory? We need policies about that. And then Tucson Tortilla, their policy is ending inventory equal to 10% of next month expected sales. So that is what we have here. Unit sales plus ending inventory, uh, total needed less beginning inventory number of units to produce. And then our ending inventory, 10% of the next month sales. And then when we combine it, we sum our unit sales, our ending inventory first quarter starts in January, ends in March. So our ending inventory is our ending inventory in March. And our beginning inventory is our beginning inventory in January. So pay attention, we never sum inventories. As well as here, we never sum prices. It doesn't make sense to sum prices. And then, okay, we will produce here 29,000 units in January, 20.5 thousand in February, 25.7 thousand in March. How will we do that? Direct materials, direct labor, and manufacturing overhead. So direct materials, exactly the same formula. And then Tucson needs 5 pounds per case of direct materials. So what do we have here? Units should be produced. These ones here that we grabbed from the uh, previous budget. We need 5 pounds per unit. So this is the number of pounds. And then we do exactly the same. Ending inventory, beginning inventory. And here, our cost per pound is $1.5. So here we will have our total costs. Here we are talking about money. Now, direct labor, much easier. We have no inventory. So, okay, this is our uh, direct labors. We need 0.05 hours per unit and we pay $82 per hour. So here, units to be produced, direct labor hours per unit here. Total hours required, we pay 22 hours at $22 per hour. This is our total cost. Manufacturing overhead, exactly the same. Here we have variable costs, 1.5 for oil used to fry chips, 0.75 indirect labor and utilities, so 0.75 indirect labor, 0.5 variable utility. So here, units to be produced, these are our costs per unit variable, and fixed costs, they are fixed. So we only copy and paste the numbers here. Operating expenses, exactly the same. We have here our variable of operating expenses, sales commission 1.5, shipping expense $2, bad debit expense 1% of credit sales. So we go back here to our credit sales here, and 1% will be bad debits. So it will be here bad debits and fixed exactly the same as the fixed costs. And then let's go to our income statement. Sales less cost of goods sold less operating expenses. So first of all, we need our cost of goods sold. So we need to find our variable cost and our fixed cost. And here we don't do it for every month. We combine the whole year. Pay attention on your master budget. I will be talking with you about that on the next video. So direct materials, $7.5, that is 5 pounds per case times 1.5. Direct labor, 0.05 hours times 22, so 1.10. Our variable manufacturing overhead, 2.5. And then our fixed, 30,000 per month. They are here, 30,000 per month times 12 months. divided by budget production volume for $100,000, 0.9. So our cost per case is $12. So our income statement is sales revenue $600,000. And then we are doing only for the first month, okay? So sales revenue first month, we have it here, $600,000. And then cost of goods sold, 30,000 units. The same because it's cost of goods sold, not the cost of production. Pay attention. Times $12. $12. Our cost per case. So 360. Gross profit, sales less cost of goods sold. Operating expenses, 142.8. That is operating expenses here. And then our operating income 97. We have no interest expense for now. Income tax expense part of this operating income, and then the net income. Okay. And then financial budgets, they are a little bit easier. Capital expenditure budget, cash collection, cash payment, combined cash and budget, balance sheet. Capital expenditures. How this is the purchase of assets. So here, a lot of copy and paste numbers, no formulas here, only for the total. So this company here, they are purchasing computers, delivery vans, production equipment. Cash collection. Here, how much will be our cash collections? Cash sales here, and then the credit sales, how much it will be? 85% of credit sales made 1 month ago, and 14% of credit sales made 2 months ago. If we sum it, it is 99. Why not 100? Because we have 1% is bad debits. Okay? And then we need to pick the numbers from our sales budget here. So this is our collection. And then cash payments. Let's check it here. Cash payments, direct materials. Tucson has been given net 30 days to pay its supplier. So in January, we will be paying the purchase of December and so on. Employment pay twice a month. So here, all of our payments will be on during the month. So we pay them on 15th and 30th. So payments of labor costs will be in January. Manufacturing overhead, we pay everything. However, insurance and property tax we pay twice a year. So we will be paying more money here in January. And then operating expenses, we pay everything in cash. So let's go here. And we are planning to pay dividends in January. So here, cash payment for direct materials. January, this number is for December, is December purchase. 12/11, January that we are paying in February. So here, 12/11, they are, whoops, here, 12/11. Here, January, we are paying in February. And then direct labor, we pay in cash. Manufacturing overhead, also paying cash. However, 107. Here, oh, let's do the February is easier. 68 points or 68 and one quarter. It doesn't match with our 81 here. Why? First of all, we don't pay depreciation. Depreciation is a non-cash expense. Please, it's a very common mistake for our exams. And then insurance we pay only in January, so we will not be paying in February. And also this one, insurance and property tax. So we are not paying this one here. So that is why we are paying only 68. And then operating expenses 97 and 132. Oh, again, it doesn't match because of our depreciation. We never pay depreciation expense, okay? And then capital investments, they are here, our capital investments only January. So we are paying this much here, okay? And then we need to combine cash collections and cash payments. So beginning balance here, cash collections here, cash payments here, and whoa, we have a negative ending cash. We never, it can't happen because it doesn't make sense to have negative cash. So we have new borrowing. So we will borrow money and then we will pay it in February with interest. So this interest here will be interest expense in February. And then here, our March and first quarter. And then we combine everything and then we have our balance sheet. So cash, accounts receivable, that is basically our cash sales plus some cash sales of December that we will be receiving only, oops, where are you here? In February, the raw materials ending balance times price per pound, finished good inventory again, ending balance times the cost per case, the prepaid property tax and insurance. So we have total current assets, property, plant, and equipment. We have here beginning balance plus our capital expenditure less our depreciations. Accounts payable, it is the direct materials that we will be paying only the next month. And then income tax, that is our income tax that we have. Where are you? No, 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 no. You are here. Income tax 34. We will pay it only in February. And then other current and liability 20,000. That is this 20,000 here, our notes payable. And then stockholders' equity, that is investment plus retained earnings. And then we have our balance sheet done. And then we have here, what if we have a lot of formulas in our master budget? If we change, for instance, let's raise our price in $1. Let's see what will happen in our balance sheet. We can do that and so on. And then flexible budget, prepare for different volumes of activities often used to evaluate performance. So chapter 10, we will be talking about flexible budgets. Budget for a merchandiser. Have no merchandise. So first of all, service companies. No merchandise inventories. We have only sales budget, operating expenses, and budget income statement, and then the same financial budget. So we have no production, no raw material, no nothing here. So quite easy. Merchandise. We have no production. We have only cost of goods sold. So here, instead of production, we will have our cost of goods sold. So what is easier here? We don't need to split this number here in direct materials, direct labor, and manufacturing overhead. Okay, guys, so this is a brief summary of our chapter 9. Please take a look at our chapter 9. If you have questions, post it in our forum. I will be more than happy to answer you, and I want you guys working together on this one. And please take a look at our Excel files as well. So see you soon in the chapter 10 video. Have a very nice and safe day.